All right, good morning, everybody. So we're looking a little better than yesterday, green on the screen. Uh, Started to see a little bit of China moving around. It's the 4th, their holiday is ending. The K-Web constituents are up. Baba, Neo, Baidu, PDD, JD, Billy, and FXI. Um, Showing Hong Kong is down, but, you know, give it time. Dow in the red, but slightly. S&P flat. NASDAQ about 0.25%. And Japan above 0.25%, looking good so far. I think everybody's just hanging out, trying to digest all of this news. We're going to get some job numbers this morning, and we're going to have a lot of Fed speakers chipping teeth. Got a lot on the table tomorrow, but that's tomorrow's problem. Once we get through the afternoon or through the lunch, the afternoon should be fairly benign, other than, the random news that's been coming out. So your 0-day play today doesn't have anything to face after lunch. Okay, maybe Dali, because we got Dali at 2 o'clock. We do have the 10-year holding above 4.5. That seems to be the level or the structure where it stopped falling, retested a couple times. It's on its way back up. Dollar back below 109. It's a good start. We want that thing below 107 and continuing to fall lower. The thing is, we don't want big moves either. All right, we see this real big move to the upside and the immediate response on the ES the other direction. Now we're getting a bit of a fade and a little bit of a pop. Don't expect that correlation to stick either, right? Or this inverse correlation. There's times where these two are perfectly inverse, tick for tick. Every move in one is a move in the other. It looks good this morning. Just watch to see if they get a disconnect. We don't have the AM edition yet, but the founder's note on the PM edition had a really good Matterhorn signal on Amazon. It's always good to save those as a reference. And it talked about going out in the options structure to around March. Go a little farther out, get some backwardation, and the vols just seem to calm down a little bit. We're still holding above the put wall. We did get the gap closed on the ES. Of course, that also lined us up with the 10, which we rejected, and we're still underneath. So we got volatility trigger and zero gamma. We're interacting with those right now, the 20-day, the 10-day, and when we zoom out, the call wall is so far away, it may as well just not be even an issue at this point. We have so many pivots we would have to get through before we could get there. We do have a voodoo line, 6120. It's another level we can focus on, and really low volume this morning, all things considered anyways. So the volume's at 97. 2 months ago, we'd be saying 97 was impressive, but at this point, it's not as much as it used to be. Everything is changing, right? So just got to adapt with the times. And you can see it where we had 183,000 or 341,000, 105,000. So 97 this morning, that's very likely a little bit of China coming back, having participants that wasn't here. They've been gone for a week. So now that we've come up and we closed that gap and we faded away from it, the fear now is that we're still going to continue this move lower and that we only came up to get the gap closed. We did get a little micro liquidity gap here, which brings us up to 60.29. It's really close to the hog line, 60.32, but that's another gap. Even though you don't see a candle gap, it's a liquidity gap. We come up and tag that and fall, then it's going to reinforce the idea that this bigger gap we filled was only a run up to get that filled and that we're going to continue to fade from here. I'll put in the argument, I suppose, that getting this gap closed like we did, running up and tagging that level and suggesting that we're going to struggle from here doesn't necessarily mean that I think we're going to go down more. We can hold the line here and just not rise, right? We can stay below 62 and stay above 58. It's a nice wide 400-point range where we can just chop around and struggle and exhaust your patience just so that they can run it uncrowded, right? They'll run it by themselves after you give up and you get out. So that is going to be the range you want to focus on. You can break it down a lot of different ways. Put it in a floor that may be more comfortable for you. I like that 5,800. I don't think we need to, become engineers and mark it down to the penny. I'll just catch this low back here from November and the high, just shoot it across from there. That's our world until something changes. So we can define halfbacks. You can try to nerd out a little bit on the quarters, but really the half is going to be the key. And just keep in mind, the longer we stay here, the more liquidity we're going to build up above and below that structure, right? So there'll be more and more people who think we're going down that are building liquidity with stops out here, and more people that think we're going up and putting stops down here. Now I'm using the ES, but that applies, SPY, SPX, XSP, same difference. So we got to get out of the box. At this point, it's just a topping pattern. There's no discernible direction, no reason to, focus on higher highs, higher lows, because it's just a big, choppy, violent mess. All right, so the move up set our ADR kind of high. Then we fell down underneath it. That liquidity gap that I was talking about, that 60.29 area, is just above the lower ADR half. We'd have to get above this red line to get that gap closed. So it's going to be a bit of a struggle anyways. Yeah, they're bringing it in with some flows. If we can get above that level, it can act supportive, but we have to get there first. That was 3 levels. If you mark high to low, that's the halfback. It's a liquidity gap, and it's the ADR half. So it's 3 levels of resistance we have to get through. The idea being, if we can get through it, not just wick up into it and then fall back down, but, close above it, maybe even Busby off of it once we're up there, get it a confirmed solid structure, we can try to begin working our way back up from there. We do have this phrase that talks about if we get to one side early enough in the day, we can go to the other side by the end of the day. And the sides that we're talking about is this lower half, the red and yellow down here, versus the upper half, the red and yellow up here. Right? It's the ADR half and full levels. Statistically, if we get to one ADR side early enough in the day, we can get to the other one. And it's not really about being bullish or bearish. You know, if you look at the upside, 6111 cog line is the upper ADR half. It would feel bullish to get there, but it would just be a part of the regular market move, right? Markets move up and down without really being bullish in that context. It's just the way like the ocean moves, right? The ebb and flow. We're underneath the weekly floor pivot, which is a fairly narrow channel for a weekly pivot. The daily pivot is really wide, and we've already interacted with that floor pivot multiple times, so it won't act as a magnet. We're already there. It's no MDP, but we did have one yesterday. And the resistance right now, yesterday's high, this gap from Friday, the Globex high, the floor pivot on the week, all of those are going to act as a resistance that we still need to get through. A wide channel implies that if we do attempt to break out, that it won't hold and that we'll fail and come back in again. The breakout that it's talking about is yesterday. So if we attempt to break out of yesterday's high, like we did in the Globex last night, this wide channel says it likely fails and comes back in again. But we could break out to the downside also, and it would still say it's likely to fail and come back in again. Just keep in mind, these channels don't make price break out or break down. It just implies that if we do, it likely fails. If it was a really skinny, narrow channel like this one back here, that would imply that if we do get a breakout, that it sticks and we actually grow legs and go somewhere. We didn't get a breakout that day, but if we had, it would have been expected to continue to move. So we got last week's point of control, 60, 79, 60, 80, right around in there. If we do get a breakout of our own Globex high, we've got that to deal with as well. It's not a perfect classic shape, but it's a pretty solid distribution of volume in a wide range from 6100 down to 6030 hog line, which happens to be this week's point of control. So that whole range or zone is just going to be really difficult to get through. Right now, we're fighting our own current point of control, 6031 cog line, and the start of that liquidity gap that I mentioned earlier. Day 30-minute volume profile with TPO. We can see the 60-80 area still has a lot of volume to it, and we're not going to lose volume on this until at least later in the day back here. Otherwise, later in the week, we're going to start to challenge this point of control that's up top, that 6132 cog line. The expectation is that it drops down into this 60-80, 60-90 range and starts to line up with the blue point of control here. I think it would be better if we can get above that level before the point of control gets there. But it's going to be restrictive either way, right? That level's still got a lot of volume, whether or not it's the point of control. So 60, 80, the level of interest. We hit the point of control that we built on Friday, hit it in the Globex last night, but we opened into it and then dropped back down through it. I'm going to keep it on the radar today, but it's no longer a VPOC because it's been hit, right? So it's a level of interest. I certainly want to keep it, but I don't want to confuse it with something else. Just modify the line type so that it's not mistaken for a regular level. We don't have a VPOC from yesterday because if we tried to mark one today, you can see that we've cut through that level multiple times already. This is shaping up to be a classic lowercase b today. We'll see how it plays out. We're still below the 10-day, a little more than 0.5%. That's not extreme. So if we're looking for any sort of extreme reversal, this isn't it. We don't have enough to the downside to even begin considering some slingshot back the other way. We're down a minor amount. It's not enough. On the week, we're just holding above the 10-week. But when we're this close to it, it acts a bit like a magnet. We'll just gravitate and hold around it, chopping above and below. We need a good catalyst to drive us off of that 10-week. Now that could be surprise news. We've been getting a lot of that lately. Or it could be Wednesday with the QRA announcement. We got the numbers yesterday, the proposed numbers, and it still looks like a continuation of what Yellen was doing. So the markets, they seem to have liked that. They didn't really respond all that much, which just means business as usual, no change. If there had been a change in sentiment from the proposed numbers that we got yesterday, I think we'd have felt it, and we didn't. So now we're focused on 8:30 a.m. tomorrow, which is when we'll get those numbers. So maybe that'll be the catalyst that drives us away from the 10-week. If not, then we continue to look at, the economic calendar and try to spot what the driver is going to be. We're still holding within our own week's range as we're supposed to. We're back up through Friday. So if we're thinking about what we've done on the week so far, we're doing better than last week. Last week when we had the gap down, it took all week from one Friday to the next to make it back up to that Friday level. And we weren't even able to keep it. We closed underneath it. We gapped down this week and we're already back above Friday's close. Now, whether or not we were able to keep it, no, we fell back down, but we were already back above it. So it's a good start. And we are underneath it now. The idea is, can we get back up there and can we get back close above? We'll see. But that's a good start compared to last week. 61.54 is the upside weekly expected move. The idea is that we close inside this box by the end of the week. And there's nothing in that statement that says, I think we'll close at the upper edge or the lower edge or the middle edge. Just that this is what we're supposed to stay within this range. So it doesn't necessarily owe us a run to 61.54. Over the last 5 days, utilities says it looks pretty good. I don't see it. Best we can say is it's still holding above the 200, but that 200 is, nearly flat. And we've got a 50 period that was downward sloping. Sure, it's starting to flatten out a little bit now, but this isn't looking all that great. It's up the most when we look at the sectors that are up over a 5-day period. It's up over 2%, but sure don't look good. For healthcare, the 50 is under the 200. There's nothing good about that. The 5200 is like a picture of health. The healthcare space is not healthy with the 50 under the 200. Now we're back above both. That's a good start. We got the 50 curling up, but it's not back above. Same thing with building materials, 50 under the 200, but prices underneath both. And right now, just getting back through that 200 seems to be the issue. And it's a flattening 200, so we wouldn't even use it as a demarcation line or anything like that. 50 and the 200 flat, sideways, price under the 200. Nothing looks good on the building material space. If we're trying to catch some, broadening out in the markets, or even a capital rotation out of the, the Mag 7 crowded trades, those sectors are green. They sure don't look good. And maybe you can make the argument that they've got room to improve and that we could see flows moving in that direction. We could, we just don't yet. Same thing with energy. Energy is still a target of the new administration. They want to keep energy low. They're doing all those executive orders and trying to keep energy down. Now, XLE, it's generic in its energy. It's got a little bit of everything in it. So if you're trying to focus on, the cost of fuel or the cost of electricity, this isn't necessarily the best vehicle for that. But I wouldn't expect much out of XLE. Given what it looks like with this completely flat scenario in this 15-point range, maybe a good place for money to go and die. Maybe iron condors legged in, or, butterflies on the edges. I just wouldn't expect this to go anywhere or do anything. But because it doesn't go anywhere and do anything, it probably doesn't have much juice to it either. The Russell and NASDAQ volatility is up. Volatility in the bond index is also up. That would be the MOVE index that we see here. Don't let that one fool you, though. The MOVE index only updates every 24 hours. It's not a live index. And, I mean, it's better than nothing, but it updates every 24 hours. Right? We've seen the moves yesterday, and it's reflecting that move now. So this isn't giving us an indication of what bond volatility is right this minute. It's more of how it has been over the last 24 hours. We can see the KWEB group that I mentioned at the start. Another one here, the MCHI, that's China as well. Both of those positive, even though China was down. Mag 7 group, it's just at our benchmark of 0.5%. SMH semiconductors also. So these two just kind of playing follow the leader. A little farther down, cloud, communications, and generic tech. These need to improve to at least 0.5%. We don't have that yet. Mag 7 positive volume flow is up. I know it's a little nuanced, but FNGU is the up volume on the FANG group, and FNGD would be the down volume in the FANG group. So positive volume is up. Nat gas and Bitcoin are down along with bonds. And that's really about where that stops. We got others that are a little weak. They're just not down enough to meet our benchmark. So when we look at the things that are up today, we have the capacity for a breakout day for a rally and a run because we've got chips, Mag 7, no real big economic events. A couple of Fed speakers that could get in the way. Now, I said no big events, but I mean, jolts, it's jobs. Anything to do with the Fed and jobs right now, you want to pay particular attention to, right? This isn't like non-farm payrolls, which would be the big one, but it is still jobs. So I expect the China stocks to continue to do good, right? That's been the plan since before they even went on break, is that they'll start catching a bid and they'll run. It's not going to be a straight shot to the upside, but they'll run into their March meeting. That's been the play. And if you haven't been in them and already missed the run, well, I'd expect a bit of a pullback, but it depends on which ones you're focused on. I mean, we had in the pre-market this morning, right there, FXI, KWeb, Baba, Neo, Baidu, PDD, Futu, TIGR, JD, Billy, all of them were up this morning. Their traders have been out for a week. Maybe they're missing some flows. A lot of these have a lot of short interest in them. There could be some people who are happy for the opportunity to try to get out of their shorts. They're going to add to the buying. It just adds to the push. But I expect the China names to do good this year. I expect more stimulus, more aggressive stimulus, real stimulus. They've been providing stimulus, but it's been this little drip, 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 nickel and dime stuff. I would expect that they're going to get a little more serious now. So we got KWeb up, FXI, emerging markets, which is China again. All of those up this morning. Cloud computing is looking better than software as a service, which is looking better than semiconductors. But if all of those are green, and they all are, then the S&P and the NASDAQ have a chance to run today. That's the catalyst, right? When we think about what's going to make the indexes move, you can have the Mag 7 do all the work. You can get, dealer hedging and options do all the work. Get an economic event that can do all the work, or you can get a combo of all three of those doing the work. It may be time for gold to take a little bit of a breather. Maybe. There's some questions I was going to dig into, and I didn't get to it in time. There's there was a huge shipment of gold moved, and that's one of the reasons that Europe came up short, right? And then everybody pounced on that and was really hammering them because they knew Europe was short. And by short, I mean they had a lack of, right? They weren't running a short. $28, $22. We just changed in gold, it seems. So they're running on April. That's the one that's got the most volume. They're not on June yet. I think they just took advantage of the situation. You can hit Google or check one of the AIs and just ask them about the gold shortage in Europe last week, and they ought to explain in better detail. There was this huge shipment that went out, and then when people were trying to, instead of they have a trade and you go to end that trade in futures, well, you can cash it out in cash or you can take physical. Somebody went to get physical and they said, hey, can you wait 6 to 8 weeks? Well, the typical waiting period is like 6 to 8 hours. So the word got out that there was a wait of 6 to 8 weeks, and more people started pounding on it. Because, I mean, spot a weakness, what do you do? Smash the heck out of it. And it just created this gold squeeze, right? I don't want to call it a short squeeze because there wasn't anybody running a short trade. It's more of a short squeeze, like they didn't have any of it. And that's what contributed to that push to the upside. Not going to stick, right? It was just a short-term situation. Same thing happened in silver last year. Well, October, yeah. Check that too. Silver shortage 2018, it's like October, something like that. There was a physical demand for silver and they didn't have it. And it caused silver to squeeze in the same way. You know who's really good for those kind of articles if you want to stay up to date on it is FX Street, right? And I know a lot of the stuff on their platform is behind a paywall, but headlines are often not, right? So you can at least catch the headline from them and then, do a little bit of fancy talk with one of the AIs and get some background on it without having to, pay for the article. So nat gas still down. There was some talk about some cold weather coming around, and then we had that nice jump up, but it just fell right back down again. I don't mess around with this. This thing is a violent mess. Depending on who your futures provider is, maybe you can, trade the other one. But if you're wanting to play nat gas, I would find companies that are heavily involved in nat gas and just leave this thing alone. This thing is, that's why I call it a joke, right? This thing is just trash. But the nat gas space, that's some good money. Just this thing is junk. Crude is down. So not XLE like we were talking about earlier. That's too generic. This is more specific. Crude is part of the target for lower energy. We're still holding above 76, but I don't expect it to stick. The range is pretty clear. We've been in it for a long time. Bitcoin is down. We failed to get through that half. Now we're setting a lower low, lower high. Solar also down. I mean, not much else to expect from solar. To see, it's pretty clear. That little pop we got in bonds didn't stick. Failed to hold above 86, came right back in again, or at 88. So all of this kind of argues that the quote broadening out that we were looking for, none of it stuck, right? Look at the things that are up, and we're right back to chips software, communications, cloud and cloud services, and China. But for the US, what we need, chips, consumer discretionary, Mag 7. So, I mean, hey, those things are what keeps the market moving up. So if that's what we have, that's the crowded trade. It's the same trade. Everybody watch the clock. Be careful, be safe. I'll see y'all tomorrow.